Yeah, well, there are, it's very current. So there's different ways of looking at this situation. I mean, one would be to say that, some of the US listed companies seem to have been more targeted. And obviously this follows a very recent IPO. And then the second argument could be that some of the, the biggest market share companies have also been more affected recently. I think, generally it's just the government sending the message that, the growth has to be controlled, and that there's a framework there that the companies have to work within. And, again, I think it's easy to be negative because of the short-term news, but, for someone that's been investing in Asia for 20 years now, if you look at the kind of compounding, the kind of, revenue growth, the kind of customer acquisition that you've achieved in Chinese tech, it's been absolutely phenomenal. And in some sectors, that's still going to be possible going forward, because there is a massive consumption power there, and there's great growth potential. So I think, the challenge is you have to look through some of this negative short term and build, positions and hold positions and benefit in the longer term. And certainly that's what we're willing to do. And we're not giving up on the, China internet. And I imagine most investors will still be invested in some way, simply because of it's what such a large component of the benchmarks that these Chinese companies are now.